please subscribe and don't forget to press the bell icon to get notified whenever we upload a new video.
But Sanjay Mookin is with us, Director India Equity Strategy of Bank of America Merrill Lynch. Sanjay, good morning. Crunching fall for the market. I mean, this is something unusual in the context of the current market, the recent market, the way the market leadership stocks have fallen 15–20%.
Well, I don't know if you can call it unusual because, stuff that goes up will probably lead the market down on the downside as well. I mean, people will sell what they have, I suspect. But it is sharper than I would have imagined, frankly, for it to have happened in the last 2 to 3 days in such a volatile manner. But we have been highlighting for a while that this year India was facing a deteriorating external environment where dollar liquidity was very predictably going to get tighter as it has. And the internal dynamics were going to get a bit messier with the upcoming elections. So the domestic sentiment, which was supposed to have held up the market for all the while, was very likely to break away. And this is what I think is kind of happening at the moment now. And my suspicion is that both these things are not going to turn anytime soon. So the market's probably going to remain weak for a while.
Okay. But good morning, Sanjay. What kind of bottom can you look at? Do you think it finds support at 10% off highs, which is very close? I mean, by the time we get to 10,700, we should be, 10% off highs. Does it find support there? Does it become much deeper? Will it threaten to take you into the bear terrain and go 20% down?
I don't know the answer to that, frankly, Lata, but what I would like to say rather than predict in the index is to say where the fair value would like. So I'd focus more on the multiples of these companies rather than to focus at an index level and how far that is retraced or not. And I think the multiples need to come back down some more because even now, Indian aggregate multiples still very high. Relative to emerging markets, we are higher still. And if you look at individual companies, most of them are still at a very high multiple relative to long-term averages. So my sense is that if this is a correction and if you are seeing some downward bias, then there is significant room further for multiples to normalize in a way.
Okay. Sanjay, hi, good morning. In your interaction with foreign investors, what's the mood like with respect to India, especially in the context of the volatility that we're seeing in the rupee? And if we do get, further rate hikes from the Fed, do you think that will finally pull the plug on the markets?
Well, let's say that until a few days ago, the Indian market was a conundrum for a lot of people because it was difficult to justify buying stocks at the exaggerated valuations that they were at 50, 60 times earnings. Only Indian stocks were kind of there in the global context. But it had been very difficult to short the market as well, given the way it had held up and the way stocks kept going up. And therefore, my sense is a lot of people were basically sitting on their hands. Now that the macro risks or external risks are starting to show up, maybe there will be an increase in foreign interest, possibly from a short side or possibly to kind of relook at their existing positions in India.
Okay. You questioned the valuations. Are you questioning earnings now? What with new factors like crude and a different valuation of the rupee, and an economist just now telling us that 8.5 is where the 10-year may peak this year?
So look, yeah, so the good news is that the rupee has different impacts on different sectors in India, of course. There is a bunch of companies which will see local currency earnings upgrades because of the weaker rupee. And there is another bunch which will see earnings risks. So there will be either margin pressures at the domestic consumer businesses or top line issues if these companies pass on the higher cost to consumers. Either way, the domestic facing businesses are likely to see earnings downgrades or earnings misses. And the problem, I think, with this sector is that they are at very high expectations. So analysts are forecasting 20% CAGRs for these companies, on which they are 40, 50 times multiples. So I think, yes, a part of the market is likely to see earnings misses. And at expensive multiples, that is not a good sign. So while we've seen a good quarter in June, for example, ex-financials, the BSE 500 at 22% earnings growth, we were still seeing earnings downgrades on aggregate. And I think that actually is more important in the near term than the actual growth number itself.
Sanjay, is there a systemic risk to this market? 3 or 4 days back, we had that just minor bit of selling, in debt market, or, that debt market freeze leading to, a stock like DHFL for falling 50-60% intraday. In financials, are we staring at a bit of a systemic risk here?
Well, I hope not, certainly. And you certainly hope that there is no contagion in terms of the solvency of any of these companies. And I put a note out yesterday saying that it's probably too early to kind of talk about those issues. Yes, there will be margin impact on many of these, wholesale funded entities, and probably growth issues as well. But it might be a bit too stretched to imagine that we are questioning the solvency of many of these, the way these stocks are falling. But I would, stick my neck out and say this is probably more an indication of the positioning of the market. People were overbought perhaps, and some of these stocks were expensive to begin with. And some of the big names, even with the correction, are still up for the year. And so then, that just kind of shows the excess valuations that we had to begin with. So my sense is it's more the issue of having fewer buyers now that this is happening, and rather than a systemic risk to my mind.
Okay, so are you in buy zone now? Do you have a shopping list? And if yes, in which sectors?
So not yet. Like I said, if I focus on the multiples, they are not on aggregate at a level that are very comfortable for me. But what I do highlight is the relative trades. I mean, people still have to be invested in the market. And I argue that this year, it's probably the rural-focused themes that will do better for a couple of reasons, because the depreciation of the rupee transfers consumption from the urban consumer to the rural producer. I mean, the farmer's input costs are all fixed in rupee terms, but the output prices tend to move with the rupee dollar as well. So rural incomes are likely to surprise on the upside, combined with the support that the government is extending through all its welfare programs. Many rural-focused sectors could benefit. Now, our analysts, of course, have their preferred stocks in these lists, but I think the whole market has downside, but relative trades-wise, we still continue to like the retail, bank-only financials. We like the rural theme in India.
Sure. For now, the market is falling some more and falling pretty hard. The Bank Nifty is now down 250 points, so 1% gone straight away. And just look at these names. Indiabulls Housing Finance is now down 6%. Bajaj Finance, 25% gone this month in Bajaj Finance. I mean, it's really falling fast now.
Sonia, that's the point I made in the morning as well. This is not the market where, you would look for any cute, counter trend rally before you can short. For all you know, perhaps in the second half today, after the kind of decline that we have seen, there could be some covering. But first half was staring down the barrel. The way the market was giving you a flat start, and the way large stocks are falling, it's obvious that there's some large-scale selling happening in financials. And the way Kotak, HDFC Twins, Bajaj Finance, yesterday, I think HDFC saw more than 1,000 crores of delivery selling. So, when large stocks fall like this, there's obviously going to be a bit of a follow-through, which is happening right now.
In fact, Sanjay, come in on this, the NBFCs. I mean, you fleetingly mentioned this pocket, but what do you do when some of these marquee names fall about 25% in a month? Do you go out there and buy, or do you wait this one out?
No, I would actually wait. And, again, I'll reiterate that rather than focus on the price action, I'd look at where the valuations are. And in many cases, they are still not in sane territory and not in comfortable ranges to my mind. And if you want to pick a level, you look at the price to book multiple or the price to earnings rather than to, point that's down 25% from peak. If you look at multiples, I would suspect that there probably is still more downside to these names.
Okay. Well, so what's the sense from the global markets itself? Do you think that anything that the Fed can do can actually worsen the situation? Or do you think, our risks are more domestic?
Well, look, they are both actually, Lata. You have two Fed rate hikes almost penciled in by the market for this year by December. And more on top of that is the reduction in the balance sheet of the Fed. And that's actually going to accelerate to $50 billion a month pretty soon. So dollar liquidity is going to continue to tighten. Dollar interest costs are likely to go up. In fact, somebody was highlighting to me that real rates by some measures are now turned positive in the US, which is going to pressure risk assets all over the world. So this was very predictable. This is something that we've been talking about for more than a year now. Our global strategists, regional strategists at Merrill, have been saying this will happen, and it is. This is not a trend that I think is reversing anytime soon. So pressure on emerging market assets, risk assets, is likely to remain until some data point or something happens in the US to cause the Fed to reverse its tightening stance, which we don't think is happening for the next few months at least.
Oh, yes, it isn't.